we are at the peak of the interest rate cycle.
Okay.
At some point, interest
It
rates
will fall.
fall.
We just don't
And-
know exactly when.
Yeah, whether it's in 3 months or 6 months, end of this year or every year people say interest rates have peaked and we should buy bonds, and again this year people are losing money because they bought bonds, and interest rates are not falling, Fed is not cutting, and it's delayed and delayed and delayed. So I was just cautioning people that just like last year, this year the future is not fixed, it's not certain. There's a lot of uncertainty. Inflation may come back, growth may slow down, we don't know.
Okay.
So I was just cautioning because there was too many people, a lot of charlatans predicting the future, saying that, hey, interest rates going to fall, Fed will cut, and therefore no-brainer buy fixed income, but we're losing money. So
I see.
you have to be careful, but we are at the peak of the interest rate cycle.
Okay.
At some point, interest
It
rates
will fall.
fall.
We just don't
And-
know exactly when.
Yeah, whether it's in 3 months or 6 months, end of this year or beginning of next year, it
Sure.
will fall.
Yep.
And most likely it will start falling within 12 months.
Okay.
And the most important thing, interest rates falling gives you positive returns for fixed income. But if, like 2 years ago, interest rates were 1-2%, it's not enough to compensate for taking that risk. But right now, you're giving 4, 5, 6, 7% yield for bonds. So you have a buffer before you start getting excess returns for the capital gains when bond prices start falling. Bond interest rate starts falling and bond prices starts going up.
Okay.
So you get the 4, 5, 7% yield. On top of that, you get the capital gain when interest rates start falling. Then sometimes returns in fixed income have given us double-digit returns. We've had 12, 13, 15% returns in
Bonds?
certain years. Yeah.
Really?
Yes.
In 1 year?
Of course.
Ooh.
So
Okay.
it is possible. I'm not saying it's what's
Yeah,
going to
yeah,
happen,
yeah,
but it
yeah.
is possible that bond returns can surprise us on the upside in the next 12, 24 months.
Okay.
So with that in mind, I think if you are willing to take that risk, right? The risk of not just being satisfied with 4 or 5% of fixed income safe,
Sure.
not short term,
Sure.
but the longer term, long duration bond, and say, hey, I'm going to try to get maybe 7, 8, 10% from fixed income, then you should be taking that risk. And then beyond that, equities, obviously, like you've seen
Yeah.
the benefit of that.
Yeah.
You've seen the benefit of taking even more risk because you're not going to take that money out of CPF. You're not
Yeah.
going to
It's-
do anything with it.
Again, it's stuck there anyway.
It's
Yeah.
there,
Yeah.
and you're contributing more and more
Yep.
every year,
Yeah.
and so every month, and so you should regularly just save and invest in equities. And if you invest for more than just 10 years or 15 years, you never lose money in equities.
Okay.
And normally you gravitate to the average, which is, the 7, 8% returns that
I
we've seen
see.
historically. In the past 10 years, it's been 10%. So it is possible to generate even higher returns if you are willing to stick it out.
I see. So what we have is, what you're sharing is that we have some bond funds, okay, low risk bond funds, okay, or even cash products, okay, and then somewhere, and these are products that might enable you to not just gain some returns or from the yield, but also potentially some upside when the interest rate were to fall. And for those people who are willing to stomach some risk, there are equity products out there, that your company carry that enables you to even get better returns.
Yeah.
But this is where I want to ask also, everybody, including myself, feel that the market is now too high. Okay. And the
Yeah.
funny thing is that when the market was low, I was, going in big time. That's and all into Endowus, by the way. Okay. But when the market was low, nobody would dare to go in. Now the
Yeah.
market has gone up and up and up and up and up.
Yeah.
Everybody say, I'm going to start my DCA right now, right? So this is where I get very concerned. I tell everybody, DCA works on paper, okay? Dollar cost averaging works on paper, but why are you starting at the high? DCA should be, you should start at a normal time whatsoever, right? Why are you starting at the high? And I feel that DCA, for these people works if they can automate the process, okay, and don't look at it, right? Don't look at it because they get affected, right? Any comments on this? Because I'm a big proponent of crash buying, and I'm a believer of DCA only if you automate the process and if you start on a normal time and not an all-time high like this, which basically means that you're driven by greed. Yeah, I don't know. What's your comment on this?
Yeah. So we don't like people chasing markets when, it's going up, right?
Yeah.
It's often, we get greedy, as you said. We're driven by the wrong motivations and we make mistakes. But when it comes to broad market investing, not just single stocks, right? If you're chasing Nvidia now or, Meta or whatever, and, maybe it will go up, maybe it won't, we don't know. But, many people make mistake when they make single stocks. But when you're talking about broad markets, this is the most amazing statistic. If you buy the market when the market reached an all-time high versus any other day of the market trading versus days, because there are many days the market has made historic high.
Yeah.
Days that the market reached historic high. Over the next 12 months, the average return is higher when you bought at the historic high.
Again, I missed that. Explain that again.
So there are many days, 365 days in a year, let's say, right?
Yes.
And in a year like last year or this year,
Sure.
we've had markets making new highs, right?
Sure.
When the market makes highs, on those, let's say, 20 days out of 365,
Sure. Right.
you buy.
I
And
buy
then-
only on a high.
Yeah. Or
Okay.
every other day, like historically, like every other day you buy.
Okay.
You compare the two, and you
Yeah.
spread it all the way back to history of markets.
Okay.
Then the days that you make a high when you buy, 12 months later, you make a better return than if you buy in every other day.
How
It's
come?
counterintuitive.
Yeah.
You know why? It's because equity markets move upward. They tend to go up.
Momentum.
And then sometimes when the market crashes, it crashes 20%, 30%, but then
Yeah.
it goes back up and makes new high.
Sure.
So 60% of the time or more, markets are actually positive in return versus a negative return.
Oh.
So because the market is skewed, we call it a skewed upwards, and the market is always trending upwards, and even if it falls, it goes up and then makes new high. And the history of the financial market is that it is one line up,
Okay.
right? And there's volatility in between, but it's
Yeah.
not one. So even if you invest at highs, because it's
Yeah.
trending up, of course it's going to make new
Yeah,
highs.
yeah.
And of course you're going to make more money.
But I would imagine that the caveat is that these guys must hold on
Yes.
and keep investing, right?
So the positive of crash investing
Yep.
is that, yes, you're probabilistically going to have higher returns because you're buying at lower levels,
Sure.
right? And so if you buy only at lower levels, so invest only on down days,
Yep.
maybe that would be positive.
Sure.
But the problem is that because it's not scientifically like accurate,
Yeah.
and you don't know exactly when, and sometimes you buy, the market goes down more and you're like, I should have bought a
Yeah,
little
yeah,
bit
yeah.
later,
Yeah, fair.
right?
Yeah.
So instead of all of that emotional baggage and stress, and you don't have time, or you missed that day because you went on a business trip and you're on a flight or whatever,
Sure.
you just do the dollar cost averaging. Whether Endowus has actually the most flexible dollar cost. You can do it every day, every week, every month. You can choose the date.
Is it an
You can do-
automated process?
yeah, automated. Every weekly, bi-weekly, monthly, every other day. You can choose the day of the week. You can choose the day of the month. You can do whatever you want. Very flexible.
And
so,
it's an automated process with your bank accounts?
so you connect it to your bank and you transfer the money, and then you can actually get that DCA going, or regular savings plan is what we prefer to call it.
Okay.
And then CPF, obviously you can do that as
Oh,
well.
you can do it CPF as well?
Yeah, you can
Oh.
set up a regular savings.
Okay.
And a lot of our clients actually do that.
Wow.
A lot of our clients do that.
Okay.
So for them, the reason is it overcomes the emotional burden of doing investing. Because
Okay.
investing is stressful, right?
Okay.
I gotta time it. I don't know if it's the right time. Markets are high. Markets are low. It's falling. And so you just remove all of that emotion and say, okay, I'm just gonna do regular savings, and don't think about it, don't stress, and just do it.
Okay.
Yeah. So
Well-
that's the right way to do it.
So
If you don't want to time it.
I would just add on that once you start on this process, don't stop it and don't
Yeah.
look at the market
Don't
and just
stop
live your
it.
life, right?
Yeah.
Yeah.
I think that's the worst thing is people actually try to time it. They suddenly, market's falling, I should stop, and then they miss the rebound. And then markets go up, so I'm going to stop, and then
Yeah.
it goes up higher. I
Okay.
think it's happening now because we've seen some behavior where investors are saying, markets are high, I'm going to take profit, and they said that 2 months ago. Markets
Really?
are much higher.
Sorry.
So I don't laugh.
No.
no, but seriously,
I don't mean
it's-
laugh at that. I'm just saying that
Yeah.
we have been telling everybody that
You
over
should not-
time the market goes up and up and up and up. You just ignore the market. Just go and live your life, right?
Yeah.
Take care of children. Go and do your work, do your hobbies, exercise. go and look at Netflix or whatever, right?
Yeah.
Just look at, my wife is the best example of a best investor.
She's right there.
Right? She just dumped the money in the market, okay, and doesn't
Yeah.
even know it exists, right? You just live a life, and suddenly 10 years later say, I got so much money right now. That's the best how investors.
It's probabilistically going to give you better returns than if you spend more time
Yeah.
on trying to time it.
Very
Yeah,
good.
for sure.
So now going back to the SA, would Endowus be able to come up with new products? Because we got about 10 months before the new scheme come about, and I know the Parliament is now debating on this issue. But assuming this bill goes through, is Endowus able to come up with new products that just cater to this group of affected SA customers?
Yeah. So we are looking into it. We so far have not offered SA products, and that is because of the higher interest rate guaranteed for SA.
But that's going to go away.
Well, that's going away after 55.
Sure.
But even before 55, we felt that we were tracking the performance of the existing funds. Also, we were working with some partners, and we'll maybe make an announcement in the next
Sure.
few months or whatever, on some new products that we're designing. So as we are, that's how Endowus is different, right? We always work to try to bring new things into CPF, into Singapore that didn't exist before. We're trying to come up with an SA solution that is going to give you a higher probability of success, and it will be a balanced portfolio, but we want to try to see if we can increase the equity portion as well. But for people who are safe, we can still return, I think, a decent return, close to, if not above 4%, with a fixed income product. So we are looking into options like that, and we may allow SA investment on Endowus platform in the future. We are working on stuff, and we will make an announcement when we can to try to serve that segment of the market that needs something to replace the 4%.
So
SA.
actually,
Yeah.
for those affected CPF members, 1865 members, that by this new policy, don't worry. There are companies like Endowus, that's going to come out with solution that help to bridge the gap. So in that sense, not to worry. There's no need to rush to buy a property right now. There's no need to rush to do something, buy an insurance product whatsoever, because options are out there, right?
Yeah.
So I think this is a great time, that we just need to be patient and everything will be fine, right?
Yeah. Actually, for SA, you can still, as I said, invest through the investment scheme beyond 55 if you invest, and then you don't have to sell it.
Now that we are forced to think of alternatives for these funds, okay, once we hit 55 years old, the scope of possibility increases widely, right? So you now have possibility to make a higher returns and things like that. If you deploy the funds positively with the partnership of people like Endowus, right? Are you still the only company that you can use your OA to buy a S&P fund or equivalent?
At the low cost, yeah.
At
At the
low cost.
0.05% or the low cost
Yeah.
of every fund is the lowest cost among out there. Other platforms charge you platform fees, take trailer fees. We don't take any trailer fees again. Like, that's commissions that fund managers pay to platforms like Dolodex and Poems and iFast Fund Supermart. That's how they make their money, is the kickbacks, the trailer fees, and we don't take any of that.
Okay.
So we are the only platform, and as a result, low-cost index funds like Amundi, 5 basis points, 10 basis points for Global World. We also have a Global Ag fixed income product. All of those are less than 10 basis points, 0.1%. Nobody else like iFast, Dolodex, and Poems won't carry it because they can't make money off of it because they're not paying trailer fees. We, don't take trailer fees. So we're still the only platform that carries that. I think there was some hoopla in Reddit or somewhere that Dolodex is starting to carry it, but they found out that it wasn't actually true. So Endowus is the only digital advisor. We're the only platform. We're the lowest cost way to buy single funds and also build portfolios. And we are working with Dimensional. I know there's a lot of fans of Dimensional in 1M65, including Loo. So I think that we're working very hard, and good news is that we're making good progress. It's going to be out in hopefully the next couple of months.
What are the fees?
Yeah. Lower than like most funds, normally 20-30 basis points, 0.2 0.3% or below. Yeah.
Very
so
good.
very low cost, very diversified, and tilted towards the proven factors of return that gives you slightly better than market returns over
Okay.
the long term.
The only thing you need to do now is to make sure you level up your investment know-how, okay? You go to support@endowus.com, write to them and say, I'm from the 1965 community. Hopefully, it give you some discount, okay? I'm from the 1965 community, okay?
You have
And
discount.
and make sure, and they will work out something that's tailored to you, okay?
The other thing is CPF Life, because you said that I'm going to be healthy, extract 1.6 million out of CPF Life, and that's great because that's something that's also very special about CPF is the annuity of CPF Life. And
even you can't beat CPF Life.
ERS, no. I mean, returns can be higher than 4%, but
Sure.
this is a minimum, basic retirement, full retirement, which you need to do. And then they now give you the option of enhanced retirement sum, which gives you a higher payout of now. I've always been complaining, $2,000 not enough in Singapore, 1,500, but now it's 3,000 something, 3,550 in 2 years' time, and it's going to keep rising a little bit. And actually, the increase in the ERS payout is actually increasing faster than the previous ERS payout. So I think it's not a bad annuity, and especially if we can keep healthy and live long and extract beyond our premiums and the interest, then obviously it's a good thing. So if you have excess and you want to get 4% plus and have an annuity and you feel like you're healthy like Loo and can extract a lot more, then take advantage of it. Why not?
Okay,
right?
This is where I need to say, okay, Mr. Loo's grand plan is to throw about $400,000 or so into the ERS, okay? Most importantly, live healthily, exercise every day. I can't say I'll eat very healthy, but at least exercise every day, okay?
Char Siu fun once in a while.
Yeah, okay, and then socialize with wonderful friends like Sam and and friends around. Live a long life, okay? I think my genes are on my side. My grandmother lived to 97 years old. My dad
nice.
is 85 and is very healthy.
Yeah.
Uncles are in the 90s. Genes are on my side. I will make sure I live to 100 years old, extract $4,600 from the CPF Life every month, okay? Till the day I hit 100 years old, I will have get back $1.6 million, okay? I know a lot of you are laughing at me. Let's try, okay? Let's try. I may fail, but
the numbers are in your favor because the average age expectancy in Singapore is now 84. For women like B, it's probably closer to 90, right? 80, high 80s. But that's when you're born now. If you live until 65, if you live until 50 or 65, then the life expectancy right now, if you're 65, you're probably going to live longer because you've already survived. So it's actually 85 or 86 for men and 89, 88, 89 for women. So you're going to live beyond 90 most likely, all of us.
So even I cannot get 1.6 million, I will get 1/million.
For sure.
For sure, right?
I think people have done the calculations. 83 years or, between 83 and 88, I think is the break even depending on which one you have.
So for those people...
90, definitely positive.
So for those people who want to juice the CPF Life Drive, live healthily, exercise. Every day I walk, 12 kilometers a day, live a healthy life, live meaningful life, and you live healthy, right? Cut down your weight, right? Yeah.
Okay. For those of you who don't know, Loo has become younger, healthier, thinner, we're the same age, but we both look very healthy.
I want to show this. I want to show this amazing photo, which okay.
Oh, what photo?
Yeah, I want to show you. Have you seen this?
Yes. Of
This
course. This is when we. Okay.
So this was me. I'll superimpose this picture. This was me and my wife. And then now this is where we are right now.
Wonderful.
2021 to 2023, right?
So B looks younger too. You both look younger.
Because we both started, on a healthy life regime. Yeah.
Wonderful.
Right. Okay, anyway, rubbish talk aside. Now, some of you said, Mr. Loo, you're just an entertainer and you're not a financial expert, right? This is the guru, okay? Guru, right? Of course, there are other smart investment experts out there as well. There's Warren Buffett, there's Charlie Munger, okay? But this is the closest I can get to a super expert. The first thing is that a lot of people right now look into S&P 500 and NASDAQ, right? And the S&P 500 grow very well, but the NASDAQ grow phenomenally, right? So the first question, the two-part question, the first question is, should we, how should we allocate our money between NASDAQ and S&P 500? Or should we even buy NASDAQ, okay? And the second question I have is that what is there in Endowus for us to buy, right? For a Nasdaq equivalent.
Yeah. Oh, Nasdaq specifically? Well, first of all, I want to take a step back because, investing is all about risk and return, right?
Yep.
And a lot of times we want to take risk and we're not compensated with the return, right? We take high risk
And low
whether
return.
whether it's crypto or whatever it is, my
Sure.
stock pick or my friends like startup, and I invested a lot of money, went to zero. So you take a lot of risk without even thinking, and you get no returns or negative returns or not appropriate returns. So taking risk should be compensated with the right amount of return. So if you're taking this much risk, you should get this much return. If you take no risk, you're going to get no returns, right?
Okay.
Or very low returns.
Sure.
So if you want to take high risk, like NASDAQ or technology, that's what it means. That you are taking higher risk because, NASDAQ did really well in 21, and then it crashed in 2022. Even NVIDIA, even Meta, they were down 30, 50, 70%. And then they've rebounded massively in 23 and 24. So it's much more volatile. It's not this, it's this, right? So it is more volatile. If you are able to stomach the volatility and the risk and the possibility that you will lose that much money, then it's okay to invest. But unfortunately, people think that they can only time the ups and not, invest the downs and still make money. It's not possible. Most people cannot time the market. It's been proven by science, data, empirical evidence that it's not possible. So what you need to do is, am I taking the right risk, and am I being compensated for taking that risk? And for most people, it's okay to just invest in a globally diversified index fund and generate the 6, 7, 10%, or S&P 500 has done more than 10%, and really enjoy the benefit of something called compounding, which is 10% growing on 10%, that makes it exponential, right? It suddenly grows much higher at a certain inflection point. So compounding is what we want to achieve. Compounding is only possible if you invest for more than 10, 15 years, right?
10, 15 years without panicking,
Without panicking.
without panic
Worrying.
selling,
Yeah.
and then rushing in again at the wrong time,
When markets
Yeah.
go up again.
Yeah.
So we've seen it already, when even in Endowus' short history, we started in 2017 as a company.
Sure.
18.
And I was with you guys.
Yeah, 18
Yeah.
Fed, started raising rates, market fell, fixed income fell. 2019 came back. 2020 we had COVID, market down 20 something %, and then rebounded very sharply. And then 22 we had another crash. So we've actually seen 3 major crashes of
In
more
a
than 20%, which is unheard of,
Yeah,
right?
yeah.
2018, 2020, 2022, every
Sure.
2 years.
Sure.
But during that time, every single year after that, markets have gone up higher. Right now, 2024, despite 2018 interest rate hike, despite COVID 2020, remember 2020 was a positive year, not a negative year.
But
Market
there was a
fell
huge
and then
dip.
came
Yeah,
back,
yeah.
so it was a positive year. And then
Yeah.
2022 was negative, but through all that, right now, we're at historic high. So it makes sense to stick it out like Mr. Loo. And I want to say that professional investors sometimes are not able to do what Mr. Loo does.
What's so
So
difficult?
professional investors know a lot, but they don't always act in the right way. So Mr. Loo acting and investing and doing the right thing is really difficult, but is even better than a lot of professional investors
Really?
and their returns. And then you take risk, because when markets fall, when
Yeah.
everybody's panicking and worried and selling, you buy.
Yeah.
And so that contrarian approach is also an interesting way, and oftentimes a good way to do it. But for most people, it's difficult. They don't have your risk appetite. So for them, it is good to invest long-term, regular savings in global markets and low cost. Really important, because not only returns compound, but cost compounds, right? It eats away at your return. So your
Okay.
return could have been 1,000%, but it's instead like 500%, which is a big, big difference
Yeah.
if costs are too high.
So the next question I have for you is about stock picking, right? I've been ridiculed countless times. Mr. Loo is such an idiot. You go and buy S&P 500, you go and buy NASDAQ, But if I buy NVIDIA, I buy Palantir, that kind of stock. Right now I'm sitting on huge amount of profits, right? So I want to hear from you some advice to our audience about stock picking.
Yeah, stock picking is a different way of investing, and for some people it works, for some people it doesn't. But the average return for all individuals is actually not great, right? And
For
it
stock
lags
picking.
stock picking versus index, market investing, because for every Nvidia, there's thousands of other names that have lost you money, right? So,
But they claim that I will pick only Nvidia and
of
nothing
course, yeah.
else.
And when Nvidia is doing well, and there's been hundreds of other stocks in the past that have done equally well, if not better. Tesla, like a lot of people were still high conviction Tesla this
boo,
year.
Tesla boo.
Yeah, and this year as well, they said, well, all this Magnificent Seven's going up. I'm going to buy Tesla. I'm going to bet everything in Tesla. They're going to take over the world. It's down. I mean, it's underperformed every other tech stock,
Yeah,
right?
yeah.
So it's the
Sucks.
same thing. GameStop. Everybody said, no brainer. GameStop. We should ride the wave. To the moon, hodl. Everything. But look where it is now. So I think it's about the risk again. So single stocks inherently has higher risk because the volatility is higher. The ups and downs are higher. Even Nvidia going up is volatility, right? Going up more is actually volatile. So it's volatility and risk that allows you to generate higher returns, but also with it comes a lot of risk to the downside when it comes. So a lot of stocks, GameStop, every other stock, you lose money. And if you think you can do it, great, try it. Many people have tried.
Can you do it?
Professional investors have tried. Yeah, I'd be happy with a 51% ratio of companies that I've picked that have done better, and 49% lose money or underperform the benchmark. That's actually a good ratio for a professional investor, because 70% of active funds underperform the benchmark. This year again, S&P 500, last year, this year, a lot of active funds have significantly underperformed because they didn't have the Magnificent Seven or Nvidia or value stocks when they rallied. Different times in markets, different things will rally, different stocks will rally. Great if you have Nvidia, but if you don't, it's okay, because over the long term, you're going to generate enough returns to generate significant wealth. Warren Buffett, Berkshire Hathaway generated 13% return. That was enough to make him the richest man.
But 13%
at some point.
is not very far away from S&P 500.
Precisely. Yeah.
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 Okay. So can you do it?
I mean, when
stock
I was an investor, and that was my day job
Yeah.
for 13 years at Morgan Stanley. When I invested, then yeah, I did a good job.
Okay.
But
you're professional, right?
I'm professional.
You got tools.
I am spending 24/7 studying, researching. I have access to better research. I have access to better advice. I have lower cost, and I am professional, so I'm trained in the way to invest. And even then, it's difficult. A lot of my peers would underperform.
Really?
I've had periods where I've underperformed significantly. It's tough. It's very, very difficult to beat benchmark for the market, because, as I said, the market is doing this. It's
Yeah.
going up.
Yeah.
If the market's flat, I would beat it. If the market's down, I would beat it. But the market's going up, and I have to beat a going up market. And it's difficult, even for professional investors.